Well, our next guest disagrees, at least when it comes to oil prices. Vincent Reinhart is a resident scholar at the American Enterprise Institute, a former director of monetary affairs at the Federal Reserve. And Vincent, always great to see you. You just published this op-ed saying that basically the Fed, the QE2, is to blame for oil prices. How do you make that assumption?
So I think what I said was QE2 is one of the factors associated with higher oil prices.
But a major factor, though.
It's an important one. As President Bullard said, it's something about the balance of oil supply and oil demand. And the Federal Reserve affects oil demand. In particular, the design principle of QE2 is to generate more inflation. In an open economy, that's associated with currency depreciation. Anytime inflation goes up and the dollar depreciates, oil prices go up in nominal terms. So Federal Reserve officials have to recognize that they're at least part of the cause for higher oil prices. Fundamentally, it's real factors like the balance of supply and demand, but the Federal Reserve is also one of the sources of uplift.
But does that mean it works on the other side when oil prices fall? The Fed is also part of that?
Well, when that day comes when monetary policy tightens, and that's not anytime soon, you'll probably put downward pressure on oil prices because historically, Federal Reserve tightening is associated with some dollar appreciation. Raising rates also makes it more costly to be a speculator. It's not just the direction of prices that the Federal Reserve affects. It's also the volatility of those prices. And right now, with interest rates at the rock bottom lows and quantitative easing encouraging, giving a little nudge to risk taking, speculators have taken bigger positions in oil and other commodities.
And I'm sure within the Fed there is a recognition that, QE2, the stimulus, the money they put in the system, has in some part driven up, what you say, oil prices and other commodities. But I guess maybe the sense is that, even if you have that rise, it's not enough to offset the gains that you get in the economy from stimulus, though. Isn't that right?
Right. That's actually how I ended the op-ed on that. More accommodative monetary policy provides plenty of encouragement through financial markets to spending and activity. But there's an offset. The offset is through commodity markets. The Fed's taken a gamble, but it's one that probably pays off in the end.
You believe it will?
Less confident than perhaps some Federal Reserve officials are, but some of the encouragement to risk-taking from quantitative easing has worked. It's not an accident that the local low in the S&P 500 was the last week of August of 2010 when Chairman Bernanke firmly put QE2 on the radar. Essentially, what the Fed said is we'll soak up $600 billion of riskless assets and encourage global investors to go into riskier assets. Got to recognize that some of those riskier investments include oil and other commodities.
All right, Vince, we will leave that there. Vincent Reinhart of the American Enterprise Institute. Always great to have you with us and to get your views on that.